Good evening, everyone, once again, and hearty welcome to today's webinar. Let me begin by thanking you all for taking the interest and time to join us today on our discussion on the UAE corporate tax. My name is Jyotika Ranjit, and I've been working with Kothari Auditors and Accountants in the Tax and Compliance Department. Before we proceed to the session, I'd like to give you a brief introduction of our company, Kothari Auditors and Accountants, known as KAA. Established in the year 1992, KAA has been proudly serving in the professional field for more than 29 years, providing management and financial consulting services, including audit, accounting, VAT, and company registration services. KAA operates in two offices located in Khalid bin Walid Street in the Emirate of Dubai and Bank Street Rola in the Emirate of Sharjah. Our associate office, Global Business Services DMCC, which was established in the year 2010, and located in Jumeirah Lake Towers, Dubai, specializes in the formation of global entities, trusts, and foundations in the UAE and worldwide. As you are all aware, the tax landscape in the UAE is continuously evolving, and with the introduction of the corporate tax from June 2023, it's time to gear up our businesses to ensure effective adherence to the regulations. As always, the KAA GBS Group is committed to ensure that our clients are updated of all the new developments in the law, and we hence have you all here at our second webinar on the UAE corporate tax. With this note, I'd like to introduce our speakers for the day. It's my privilege to introduce before you Mr. Vipul Kothari, the founder and head of KAA and GBS. He has the distinction of passing the Chartered Accountancy at the age of 21 from the Institute of Chartered Accountants of India, and went on to receive gold medals from BK School of Business Management in MBA Finance. We also have with us Ms. Kinjal Mehta, the Manager, Tax and Compliance at KAA. Chartered Accountant and Company Secretary by profession, Ms. Kinjal holds a rich experience of 10 years in the field of direct and indirect taxation in India, Kuwait, and Dubai. She also holds Diploma in International Taxation from ICAI. Going forward, the question and answer session will be taken over by Mr. Prasad Phonde, Senior Manager, Audit and Compliance, who is a Company Secretary in addition to many more professional qualifications and has over 20 years of experience in the professional field. Before I hand the session over to the speakers, please note that the session is being recorded and all the participants are muted. Having said that, we'd love to hear from you, and in case you have any questions, please raise them in the chat box and we shall answer them at the end of the session. So without delaying any further, let's move on to the session. Over to you, sir.
Thank you, Jyotika, for your kind words of introduction. And welcome, good evening, welcome everyone to this session on the corporate tax, where we'll be taking and sharing with you the information which has been made public by the ministry by way of public consultation document. Let me just share the screen, the presentation. I hope my voice is clear and I'm audible. So corporate tax, as we had covered in the previous session also, is a move by UAE to ensure that it is in compliance with the international best practices and the global corporate compliances. This is also a part of efforts by OECD to ensure that primarily there are no more tax havens, and internationally the profit shifting and base erosion which was happening globally is primarily not happening. As a part of that, OECD actually started their various action plans, and they have been actually in the process, which started initially with signing off various tax information exchange agreements way back. Thereafter, certain tax treaties were signed, and then certain action plans were laid out, which has been agreed by most of the jurisdictions globally, which they will implement over a period of time. As a part of that initiative, and UAE also has agreed to BAPS action plan, it has brought in various compliances and regulations. If those of you who are in UAE are aware that since 2018, there have been many corporate compliances which have come in, which started with introduction of excise tax, thereafter value-added tax, VAT, and then we had economic substance requirements, the ultimate beneficial owner requirements, and of course, tightening of the anti-money laundering regulations. Now, as a part of that entire process, this, I believe, is one of the major and the most important aspect of that entire BAPS action plan, which is introduction of the corporate taxation. UAE has already agreed to that, and it is already announced that the corporate tax is going to be introduced effective from the financial year starting from 1st June 2023. So effectively from that period onwards, the corporate tax would be applicable to all the entities on the business profits that they generate within UAE and internationally also, as we'll come to in the later part of the presentation. And the objective that the Ministry of Finance and the Federal Tax Authority, which will be the implementing agency or the monitoring agency for the corporate tax, is to ensure that the best practices globally are introduced with minimum of compliance burden. So as we have seen in VAT also, that there is a very simple VAT return that needs to be filed. We believe that corporate tax also will have minimum compliance because only one return filing annually would be required, which again may not be so extensive, but of course much more than what VAT we are currently filing. Thereafter, on 28th April, Ministry published a public consultation document which gave more detailed insight into what the corporate tax law would be having. And this is, I would say, a path breaker, because I believe for the very first time, UAE has come out with a document where public consultation has been, it's been floated so that public can give their opinion, suggestions and recommendations, which the ministry would evaluate, and they would then in turn try to implement or incorporate those things whichever are possible in the final corporate tax law. So this public consultation document gives us an idea in what direction the corporate tax law would be expected and what are the broad constituents and the outline of the corporate tax law. Of course, this does not give the entire corporate tax overview because the regulations have still not been announced, and these are expected to be announced somewhere by mid of this year, so probably in the third quarter of 2022. And the effective implementation, as announced earlier, also is for the financial year starting from or on or after 1st June 2023. So in general, people will have time to ensure that they are able to change their systems and processes to ensure full compliance to the corporate tax law. Now, the corporate tax law, I'll cover certain initial part of it, and thereafter my colleague Kinjal would cover in detail about the remaining part from the public consultation document. The corporate tax would be applicable to which all entities or individuals. So primarily, as given in the public consultation document, it has been classified into 4 broad categories: legal persons, natural person, exempt, and free zone. Now, legal persons are primarily all the UAE companies and legal entities which are incorporated within UAE. So all the companies which are incorporated within UAE would be covered under that. Foreign legal entities which has permanent establishment in UAE. So these legal entities may not have incorporation or license from UAE, but they might still have permanent establishment, meaning they might have an office or some place of operation from where they are operating. They would also be covered. Even limited liability partnerships would be covered, and even unlimited or general partnerships would be also covered, but they would be treated as tax transparent, meaning the individual partners' share will be added to partners' income and then it would be liable to tax. So these are the persons who are going to be covered. Natural persons or individuals, if they are engaged in business or commercial activity in UAE, meaning sole proprietorships, which are unincorporated entities, they would get covered. However, an individual which has employment income or other personal income, which is probably, let's say they have some rentals or dividends or interest income, capital gains, these will not be taxed. So similarly, any person residing in UAE, whether it's a UAE national or a foreign national residing in UAE, will not be taxed on personal income, meaning employment income, rentals, dividends, interest or such other income. However, if they are carrying out some business activity, then definitely it would get covered and they would be liable to corporate tax. The document also says certain exemptions. So primarily the exemptions are mainly to the federal and emirate governments, government entities or companies which are carrying on some sovereign activities, certain companies which carry out extraction and exploitation of natural resources, meaning mining and maybe oil and gas, because these are subject to emirate level taxation, because that's the emirate subject. Each individual emirate would tax. And then there are charities and public benefit organizations, which are again, which are approved and which are listed by the tax authority. Pension funds and certain investment funds, which are subject to meeting of certain criteria. So these would be exempt. They will not be covered under the UAE corporate tax. Free zone companies also will be covered. So whether it's free zone company or branches which are established within the UAE free zones will be covered under the scope of UAE corporate tax. So they will have to register. They will have to also file the tax returns. However, what has been stated is that if the free zone where they are registered, such companies are registered, is offering or has offered tax incentives in terms of tax holidays, then this will be continued by the tax authority also, subject to meeting of certain conditions. Now the conditions are primarily that they should not be doing any local or UAE business. They should only be doing international business. Then they might be entitled to 0% corporate tax, meaning they will have to do the filing. However, their income will be subject to 0% corporate tax. So UAE free zones, as I mentioned, 0% would be applicable, but again, there are conditions which needs to be fulfilled. One, on income earned from entity located outside UAE. So primarily free zone, UAE based free zone does business internationally or with another company in the designated or such free zones where the corporate tax exemption is being granted. On that income, profits, whatever are earned, will be subject to 0%. On passive income, which means interest, royalties, capital gains from shares in mainland companies, this would be also exempt, or so as to say 0% taxed. And also transactions between free zone entity and mainland group company. However, there is a caveat to this, that the mainland company will not get such payments which they make to free zone as deductible expense. And also, if the free zone company is selling goods to mainland, then primarily the free zone, the mainland company on which is importing the goods will be considered as importer on record for value-added tax purposes. Then income on that would be subject to 0% tax. However, one thing that one needs to take care of is that if such free zone companies which carries out, let's say 99 and generates 99% of their income from international or such passive income, but even if they have 1% income or less than that, it would make them, basically they'll not then be eligible for 0% corporate tax. So this is one major thing that will have to be looked at, because if a free zone company, which normally happens, also does mainland business and also does the international business, in such a case, they will not qualify for 0% corporate tax exemption. So this is one thing which all the companies will have to evaluate, specifically those which are in the free zone, and they'll have to then take care of how to basically plan going forward. So this chart gives details of if there is a transaction between a free zone person which is located in a designated zone for VAT and which does business with a mainland company. So what happens in such a case is that the mainland company will be considered as importer on record. So custom clearance will be done under the custom code of the UAE mainland company. In that case, the free zone person or the company which is selling the goods and generating income, for them, it would still be considered and eligible for 0% corporate tax. Of course, 0% withholding tax, so primarily no withholding tax will be there on such mainland sourced income. In the other case, the second part, where there is a transaction between free zone person and mainland company. So primarily where mainland company is not importer on record for VAT purposes or for custom duty purposes, in such a case, the free zone person is deemed to be doing business in UAE, within UAE. And this will disqualify them from getting the benefit of 0% corporate tax. So these are the broad coverage of the different categories of person who will be liable for corporate tax, and those who can get exemption and those who can get probably 0% corporate tax benefit. Okay, so going beyond, I will request Kinjal to take over and share the presentation and take the discussion further. Thank you.
Sure, sir. Thank you. I'll just share my screen. Is my screen visible now?
Yes, it is.
Okay. Good afternoon, everyone. A very warm welcome to our series of webinars on corporate tax. My name is Kinjal Mehta. I work as a tax manager with Global Business Services. I would like you to go through the basis of taxation, how the corporate tax is calculated, the participation exemptions, the expected administrative tax compliance as per the public consultation document. So when we go to the basis of taxation, residency is a key criteria of determining whether the business profits will be subject to corporate tax or no in the UAE. So a legal person that is incorporated in the UAE will automatically be considered as a resident person for the UAE tax purposes. Equally, a natural person who is doing business activities, who's engaged in business or commercial activity in UAE, either through his own name or through an unincorporated partnership, will also be considered as a tax resident for the UAE tax purposes. A foreign company may also be treated as a resident company if it is effectively managed and controlled in the UAE. Now, how do we determine whether the company is effectively managed or controlled in the UAE? It's, of course, a question of fact, but majorly it would depend on where the directors or the decision makers of the company are located and where the commercial decisions and the key management decisions are made. Depending on that, the foreign company can be treated as a resident or a non-resident company. UAE resident person will be taxable in the UAE on their worldwide income, while the natural person, like an individual, the worldwide income taxability will be limited to the income earned from their business activity carried out in the UAE. So where income earned from abroad is not exempt, so it is taxable, the income taxes paid in the foreign jurisdiction can be taken as a credit against the tax that is payable in the UAE for that particular year. Now going to non-residents. So non-residents, they have proposed that the non-residents will be subject to corporate tax on the income from their permanent establishment. So the taxable income of the non-residents of their PE in UAE would be taxable. Also, the income which is sourced in the UAE will be taxable for the non-resident persons. The activities that will trigger the PE of a foreign company in the UAE will be determined on the two tests which they have given. One is the fixed place of business test, and the other is the dependent agent test. So this PE concept has been taken from Action Point 5 of OECD BEPS project. So depending on the nature of income, the taxation will depend. Now going to the calculation of the taxable income. So let us see how the proposed approach towards determining the amount that needs to be subject to corporate tax. The UAE corporate tax regime proposes to use the accounting net profit or loss as stated in the financial statements of a business as the starting point to determining the taxable income. So using this accounting standards provides for a common definition of income and thus prevents the businesses from maintaining two sets of books. So one for the purpose of corporate tax, one for the purpose of financial reporting. So to reduce the compliance cost for the companies, they have used a standard definition of income, which is as per the accounting standards. So the financial statements need to be prepared according to the accounting standards and principles that are generally acceptable in the UAE. So that is the IFRS. And the businesses will use their financial accounting period as their annual tax period. The UAE corporate tax regime also disallows or restricts the deductions of certain specific expenses from the taxable income to ensure that relief is obtained on expenses that are incurred only for the purposes of generating taxable income and to avoid the tax abuse. So in this context, they have proposed a few rules. So one is the interest capping rules. So interest and similar financing costs are of course considered as cost of doing a business and accordingly will be deductible from the corporate tax taxable income. But there is a cap on the amount that can be claimed as reduction. So the cap that they have given is the amount of net interest expense that can be deducted up to 30% of the business earnings before interest, tax, depreciation, and amortization, as adjusted by the corporate tax purposes. So depending upon the interest, there is a cap of 30% of the interest that can be claimed against the taxable income for the corporate tax purposes. Now, this cap does not apply to specific industries where they understand that the need and the risk profile are different. So it won't be applicable to banking business, insurance business, or such regulated financial services. Further, the related party payments made to free zone person that are taxed at 0% on receipt of the income will not be deductible for the corporate tax purposes. So if the payment is made from the related party to a free zone company who's taxed at 0%, the interest will not be allowed as a deduction for the mainland company. Businesses will be allowed to deduct up to 50% of the expenditure that they incur on entertainment basically. So it could be anything related to your customers, to your shareholders, suppliers, prospective clients, other business partners. So any expenses in the nature of entertainment can be deducted up to 50% in a financial year. Further, there is no deduction that will be allowed on specific expenses like the administrative penalties, the recoverable VAT, the donations paid to unapproved charity organizations. Going to foreign branch exemption. So UAE businesses may structure their foreign operations either through a foreign subsidiary or a foreign branch. So a foreign branch would typically form a PE in the foreign country and will be subject to corporate tax in that country. If it is subject to corporate tax, they will pay taxes abroad. And being a resident of UAE, they will also have to pay taxes in the UAE. So to avoid double taxation, they have given option to the foreign branch, the income of the foreign branch to be taxed. The tax can either be claimed as a foreign tax credit. So whatever tax you have paid in the foreign jurisdiction can be claimed as a foreign tax credit, or you can elect for an exemption method. So you can apply to the FTA and elect for exemption of that income of your branch in the foreign jurisdiction. So this is basically to avoid because what happens is, for a foreign subsidiary, financials are prepared, but for a foreign branch, standalone financials will not be prepared, and it is very difficult to determine the income and expenses that are attributable to that branch. So in that case, it is always a challenge for a foreign branch to determine the attributable income and expense. Hence, they have given two different methods by which they can claim the relief. Going ahead, we have something called participation exemption that they have given in the proposed document. So the UAE resident companies will be subject to corporate tax on their worldwide income, including the capital gains. But however, there are certain exemptions provided which relate to income earned by UAE companies from investments in other countries and from operations conducted outside UAE through foreign subsidiaries or through foreign branch. We've already seen how for the foreign branch exemptions or foreign tax credit will work. Let's look at the foreign subsidiaries. So a corporate shareholder will generally be exempt from corporate tax on dividend received and capital gains earned from the sale of shares of its 100% subsidiary company. But UAE corporate tax regime will also exempt the dividends earned by the UAE companies, including dividends from the free zone companies that benefit from 0% tax regime. Now, dividend paid by foreign companies and capital gains from the sale of both UAE and foreign companies will also be exempt from corporate tax, provided there are certain conditions which need to be met. The first condition that they have given is that the participation, for claiming this participation exemption, is that the UAE shareholder company must hold at least 5% of the shares in the subsidiary company, and that foreign subsidiary company is required to be subject to tax of at least 9%. So if the foreign subsidiary is in a low tax jurisdiction, then in that case, this exemption may not be applicable to them. So going ahead on that, so in spite of benefiting from a 0% tax rate, capital gain on the disposal of shares of a free zone company will be exempt from corporate tax, where the free zone company is a holding company. So this is an exception that they have given. Even though the corporate tax is 0 for a free zone company, if that free zone company is a holding company and substantially all its income is derived from shareholding in subsidiaries that meet the participation criteria, then yes, the exemption can be given to such companies as well. So we have these 3 examples wherein the domestic company's dividends is exempt, dividends from mainland company to a foreign subsidiary that also is exempt subject to the conditions of shareholding 5% and corporate tax of 9%. And then when there is a disposal of shares from a free zone company to a mainland company, in that case, if the conditions are met, then again, the exemption can be granted. Okay, going ahead, intra-group transfers. So there is a relief which is given, which is available on transfer of assets or liabilities between UAE resident companies that are subject to at least 75% commonly owned, provided the assets and liabilities being transferred within the same group for a minimum of 3 years. So if there is any transfer of assets or liabilities between the UAE resident companies that have common ownership of at least 75%, and they remain within the group for a minimum of 3 years, then there is a relief for the intra-group transfers. So there will be no tax as such on such transactions. So when this is claimed, the relevant assets and liabilities will be treated as being transferred at the tax net book value. So neither there will be a gain nor there will be a loss that needs to be accounted for when calculating the taxable income. So when the relevant conditions, so if the conditions of the shareholding and minimum 3 years criteria are not met, the gain or loss that would have arisen at the initial transfer, which will be included in the transferor's tax return. So the transferor will have to pay tax in the year in which the conditions are not met. The tax that he needs to be paid is on the gains that would have occurred on the initial transfer. So in the year 1, suppose they did the transfer, at that year, how much tax would be required to be paid by the transferor, that he would have to require to be paid in the year in which the conditions are not met. So any of these criteria are, the regime, basically the corporate tax regime, is generally allowing restructuring, reorganization of the companies, of the group companies or mergers to be on a tax neutral basis, such that there is no taxable income or gain that arises on such transactions. They will also allow exemption or allow for a deferral taxation where the whole business or independent part of the business are transferred in exchange of shares or ownership interest. So basically any restructuring relief that has been given, and if the conditions again are not met in the further years, so minimum 3 years, these conditions need to be met. If during the 3 years, anytime they're not fulfilling these conditions, the relief that has been given will be clawed back, and there'll be subsequent transfer. If there's any subsequent transfer to third parties, then the transferor has to pay tax on what relief he has earned in the year 1. Going forward to the losses, so the basic fundamental principle that they have come out on in the UAE corporate tax regime is that corporate tax is meant to be paid on the total profit of the business over the entire life cycle, as opposed to a single financial year. So a business will be able to offset loss that has incurred in one period against the taxable income of future periods. And this will be up to 75% of the taxable income in each of those future tax periods. So the tax losses can be carried forward indefinitely, provided there are some conditions. The shareholders hold at least 50% of the share capital from the start of the period till the time the loss is incurred. If there is change in ownership of more than 50%, tax losses will still be allowed to be carried forward, provided the same business or same business line is continued or carried on by the new business owners. Okay, tax group. So the UAE corporate tax regime allows formation of a tax group. So operating through a group of companies can of course increase the overall tax compliance cost, where each entity will have to report taxable income on a standalone basis, and as a result of which there could be a higher effective tax rate in one company which is making profit, and there will be loss in the another company. So to avoid this, they have proposed formation of a tax group. So a UAE resident group companies can elect to form a tax group and be selected and be treated as a single taxable person if the parent company holds 95% of the share capital and voting rights of its subsidiaries. Now, to form the tax group, neither the parent company nor any of these subsidiaries can be an exempt person or a free zone company that benefits from 0% tax rate. And all the group members need to ensure that they follow the same financial year. If these conditions are met, then they can form a tax group. Application needs to be made by the parent company, and a single tax return, if they've applied for a tax group and it gets accepted, one single tax return needs to be filed for the entire group. Okay, with introduction of corporate tax comes the introduction of transfer pricing. So the corporate tax regime, they have given the transfer pricing rules. So they are going to introduce the transfer pricing rules. Right now, they do not have any such rules. So they'll introduce such rules to ensure that the transactions between the related parties are at arm's length price. In order to do that, the arm's length concept is applied, which is the internationally recognized arm's length principle between the related party and the connected party. So basically, if it is applicable wherever relevant, the business will be required to submit a disclosure containing information regarding the transactions between their company and the related parties and the connected parties. Also, the businesses will have to maintain and submit a local file and a master file. So let's see how this corporate tax calculation happens. So corporate tax will be charged on the annual taxable income of a business, which will be 0% for the taxable income not exceeding 375,000 dirhams and 9% for taxable income exceeding 375,000 dirhams in each financial year. Further, there is a 0% withholding tax will apply on domestic and cross-border payments made by the UAE businesses. So even if it is a 0% withholding tax, UAE businesses will be required to make any deductions from payments made. So UAE businesses will not be required to make any adjustments or any deductions from the payments made, nor there will be any obligation for them to file the withholding tax returns. So if we have to calculate the corporate tax, we have to first see the net profit before tax as per the audited financial statements. We need to do the adjustments. We need to add the expenses which are not allowed for the corporate tax. We need to reduce the income which is not taxable as per the corporate tax and reduce any other adjustments. Based on that, you will get a taxable income. So that taxable income, the first 375,000 is taxed at 0 rate. And anything excess of 375,000 will be taxed at 9% rate. If you have paid any tax in your foreign jurisdiction, that can be claimed as a foreign tax credit, or you can apply for an exemption for that income earned in the foreign jurisdiction. Okay, going to the tax compliance. So a business will be subject to corporate tax, will have to register with the FTA and obtain a. So every businesses which are registered, which will be subject to corporate tax in UAE, will be required to register themselves with the FTA and obtain a tax registration number within the prescribed time that they will announce. The FTA also has an option to automatically register a business for corporate tax purposes if the business does not voluntarily go ahead and ask for the registration. So yeah, so the timeline which they have prescribed is 9 months from the end of the relevant tax period. The principle on which the corporate tax is based is the self-assessment principle. So basically, you have to assess your taxable income, what you are eligible to claim, what are the deductions allowed. Based on that, you need to assess and file the tax returns. There is an option to apply for a clarification, how we have for VAT as well. We can apply if there is any ambiguity or uncertainty on the tax treatment of a particular transaction. You can go ahead and file for a clarification from FTA. Businesses will have to prepare and file tax returns, only one tax return for the financial year, and other related supporting documents and schedules with the FTA for each tax period. There is no requirement to file a provisional corporate income tax return or an advanced tax return for the corporate tax purposes. There's a requirement to maintain the books of accounts and the financial records which support the schedules and the supporting documents for the corporate tax return, taxable income that has been filed. Also, a free zone entity to claim a 0% tax, they will have to audit their financial statements. So if there is audited financial statements, then only they can claim the 0% tax rate for corporate tax purposes. So going through the example, if your financial year ends on 31st March, your first reporting period will be 1st April 2024 to 31st March 2025. The first corporate return that will have to be filed is from the 9 months from the end of the financial year. So that will be 31st of December 2025. The tax return and the tax payment both needs to be done within 9 months from the end of the financial year. If your year ends on 30th of June, so your first reporting period would be 1st July 2023 to 30th June 24. Accordingly, 31st March 25 will be your first tax return. And by that time, you need to also file your pay your tax payments for the corporate tax. So yeah, I will request Mr. Vipul to take ahead from here.
Thank you, Kinjal. I'll just share the screen. Sorry, just give me a minute. Yeah. Okay, thank you, Kinjal, for the detailed presentation on the broad outline of the UAE corporate tax regime. As you have seen, of course, it does sound simple, but there are quite a few complications that businesses definitely would have. Though we have time period of, let's say, 14 to 20-month period to prepare for corporate tax, depending on your financial year. And then the filing is another 9 months from the end of the financial year. However, having said that, this is a short period, because what would need to be done is a lot of alignments, a lot of realignments may need to be done. You'll have to assess whether the financial year is the right one for you or not. Also, your business systems, accounting systems and processes will need to be evaluated, because as we have seen many a times, companies have multiple entities doing the businesses. So they have mainland entity, they also have free zone entity, and the books of accounts are maintained as one set of books of accounts, because the business is all done together under one particular umbrella. Now, in this case, again, you may need to segregate it, because if you wish to have your free zone business, which might be doing only international business, benefit from the 0% corporate tax regime, then you'll have to have separate books of accounts and ensure that the registration for that company is separate. Also, tax grouping is something which you may have to also assess, that are you able to do a tax grouping, because the conditions which are mentioned are 95% holding, so sort of a parent subsidiary relationship. Because only if you have tax grouping, the losses of one entity would be allowed to be set off against the profits of the other entity. However, if you are not able to do a tax grouping and you continue to have business in such a way where one of the entities is having losses and other is having profit, it might happen that you might effectively end up paying a higher percentage effective rate of corporate tax, because you are not able to set off the losses in the other company because it is not under the tax group. So again, the business operations will need to be modified. All said and done, it is not going to be just change of your books of accounts or the systems, accounting system or processes, but sometimes even the business model will have to be realigned. It may so happen that a company might have free zone entities and mainland, but the business for international trade is being done through the mainland entity. Now, in such a case, probably if you route it through free zone and a free zone only does international business, there is a possibility of benefiting from the 0% tax rate. So again, business process and entire business model may have to be reworked. And that is where it is necessary that one needs to start thinking of now, start the planning, take the steps to realign your business, because there might be some legal and regulatory changes that you may have to do to your licenses, to your business operations. Sometimes, what happens here, the shareholding is in such a way where it is fragmented between different members of the family. So one company may not own 95% of the other company, and you cannot do the grouping. Now, in that case, again, you may have to do the change in the holding structure. Even the related party transactions, which till now we have seen that most of the companies and entities do businesses with related parties where the transfer pricing guidelines may not be followed. Now, if this continues, there is a probability that such transactions and the expenses or the payments made to related parties may be disallowed. Because as mentioned in the public consultation document also, the related parties which have been defined are in very great detail, and it goes up to 4th degree relative. It's not just 1st degree relative, it is going all the way up to 4th degree relative. So transactions with related parties, which would include not just interest payments, which of course has been capped at 30% of the EBITDA of the company, but even salary payments, commission payments, or director remunerations, these all will come under a scanner. And in all probability, there is a possibility that some of those may not be allowed as an expense. And if that happens in reality, the corporate tax rate, effective rate that you would pay probably could be much higher than 9%. So these are very many things which will need to be done. There might be certain type of expense which will be disallowed. So again, it will have an impact on the effective rate of tax. the cash flow effect of this will have to be also assessed and planned for, because obviously this is a cash outgo, the tax payment that is going to be made. And most important of all is even the audit part of it, because though VAT does not require audit compulsorily, but we have seen at the time of assessment, audit is essential. They ask for audit reports also in many cases. Similarly, for corporate tax also, for mainland entities, though it's not been stated that the audits would be compulsory. However, based on the experience at the time of assessment, there is a probability that the audited financials would be required. For free zone entities, in order to claim 0% corporate tax benefit, audited financials would be required. And that's where now the process, as we say, is to begin now in a phased manner, because currently the corporate tax law has not been announced. So we really do not know the full law and what would be applicable, what would not be applicable. However, having said that, broad outline is known. Based on that, the possible impact assessment can be carried out currently. And after the regulations are issued, detailed assessment and planning and designing can be done. And thereafter, of course, the integration and implementation is required to be carried out. And once that is done, and you are into a financial year where the corporate tax would be applicable, then obviously the ongoing review and ensuring that we do the compliances on a timely manner. This is what is required to be done. And this is what we urge all the companies, that please start working on it now. Of course, our team and our experts are available for any guidance and support that you may require in this particular process. So you can reach out to me or Kinjal, or of course Jinesh and Prasad, either of them, for any corporate tax related queries and support. With that, I would like to conclude on the presentation, and I'm sure there will be quite a few questions. So we can go on to the Q&A session. Thank you very much, everyone.
Yes, sir. Thank you, sir. Thank you, Kinjal, for an insightful presentation. I'm sure the participants have gained a lot of insight into the corporate tax regime. And obviously, when the regulations come, a lot of things will be clearer. So now let us go to the question answers session. I would just like to inform all the participants that if you want, you can post your questions in the question answers chat box, or you can also raise your hand. We'll unmute you and you can then ask your questions. So let us first take some questions from the chat box. There's one question. If a foreign company has a temporary office in UAE and the activities are carried on from the office, will it be considered as having a business in the UAE and required to register and pay corporate tax?
So basically, you're saying that a foreign company has a temporary office in UAE.
Yes.
Okay, so a foreign company will have a PE in the UAE if it has a fixed place of operation. So maybe an office, a temporary office, a place of management, something like that for over 6 months of period. So if the temporary office is carried, so the activities from the temporary office is carried out for more than 6 months, it will become PE and it will be taxable in the UAE. If it is less than 6 months, it will not be considered as a PE of the foreign company. However, if it is more than 6 months and the nature of the activity which they are doing in UAE is sort of like just marketing or promotions, like basically auxiliary or preparatory, this is a term that they use in the tax treaties, preparatory or auxiliary services, then in that case, again, even if it is more than 6 months, it may be considered as not a PE.
So there are, I just would like to add what Kinjal has said. So there are very many conditions. We cannot have a watertight yes or no in this case. Every case will need to be evaluated. And again, one more test also is there for this, which is called dependent agent test. So it's not just company having permanent establishment, but maybe, they do not have, but they are depending on an agent which actually carries out all the activities on their behalf, probably also may fall under the PE concept or PE thing and might be liable. So obviously we'll have to evaluate the entire operations and understand exactly and then take a call on this. But yes, one has to tread carefully. Broadly, what Kinjal said, 6 months is the threshold one can look at, but that's not the only rule or the only criteria.
Okay, second question we have is, what is the UAE sourced income? Can you give us some examples?
Okay, so UAE sourced income could be considered as any income which is earned from a UAE resident company or from the PE of a foreign company which is resident in UAE. So if such income is earned, it will be termed as a UAE sourced income. But having said that, in the public consultation document, they have no clear rules or guidance in this regards.
Okay. One more question. What consideration should be taken in mind when giving loan to related party?
Okay.
So if you are giving loan to RP from CT point of view, what things should we keep in mind?
Okay, considering that the related party and the persons giving loan both are UAE resident, the transaction first of all has to be on a arm's length basis, of course. The other thing which comes in my mind is if the borrowing is made for a specific reason, supposed to to pay a dividend, suppose if they have taken a borrowing just to pay a dividend, then that deduction will be allowed only and only if there's a valid commercial reason to it. So what they have mentioned in the public consultation document is that a valid commercial reason could be considered if the related party is subject to 9% tax. So the lender related party has to be subject to 9% tax. In that case, they consider that as a relevant commercial transaction. So basically, it has to be on arm's length.
Yeah, so I think one thing we have to see from this is all transactions with related parties are going to be under scanner. So one, it will have to justify that they are on arm's length basis. Second, it also will need to justify that it was a business need and not just a tax evasion or avoidance mechanism to minimize the corporate tax liability. So, these are the questions that one will have to really assess for any related party transactions, be it interest or be it any expense which is paid to a related party.
Correct. So one more question. We have multiple branches in different parts of the world. Some countries are taxed and some don't have tax. In this case, how the branch profit exemption can be claimed?
Okay, so the foreign branch profit exemption can be claimed if they are paying the taxes outside UAE. So in case they are not paying taxes, this exemption is not available. Also, if they are claiming an exemption, it has to be for all the companies. They cannot cherry pick one country or one branch and then they say that, okay, we apply exemption over here and we apply foreign tax credit over here. No, that's not allowed. If they're selecting an exemption method, it has to be for all the countries. And if one of the country also is not paying tax or not paying sufficient tax, at least of 9%, then in that case, they cannot apply for the exemption. They have to claim the foreign tax credit, pay taxes outside UAE and claim the credit of that taxes in the UAE income.
Correct. We have a couple of hands raised. Let us go to Ms. Asima. Ms. Asima, I will unmute you. Asima, now you can unmute yourself and ask your question. Ms. Asima?
Maybe we can go to the next
one. Yeah, we have Mr. Sadiq also. Mr. Sadiq, you can also ask a question. You can unmute yourself and ask a question. Okay, we'll go to the next one, Mr. Mohan. Mr. Mohan, you can ask your question.
Hi, I just want to know, like in a free zone, whether services are taxable.
Yes, services, see, free zone again will go based on free zone. If free zone is providing service to international companies only and not to any local mainland, then there is a possibility that they would be able to get the 0% tax, but if they're providing service to local entities, definitely it would be chargeable to, normal rates of corporate tax.
Thank you, sir.
So in this case, sir, I'll just like to add, if a company, like we saw that if a free zone company is dealing with a mainland company in goods, and the mainland company acts as an importer, in that case, then the free zone entity can claim 0% corporate tax. But if a single invoice is of service invoice, in that case, there is no question of importer.
No.
And in that case, the free zone entity will have to pay corporate tax on its entire profits, correct?
Entire, including the international business.
True.
And that free zone company has to be in the designated zone for the VAT purposes.
Yeah, true. Not only free zone, a designated zone.
Now, this is another, so as to say, a question mark. All the free zones have been announcing that, we give corporate tax exemption. But probably if you ask the free zone to give in writing or the regulations which specifies that are this free zones eligible, or companies registered in this free zone, are they eligible for corporate tax exemption? It's very difficult to get such a document. So again, question will remain. In all probability, what would happen is like what happened in VAT. The FTA will come out with a list of free zones which would be considered as having granted the corporate tax exemption. Correct. And eligible, then companies registered in those free zones will be eligible to then claim the 0% benefit. So, so even from tax planning perspective, one has to keep in mind, if someone is, let's say, restructuring their operations and now deciding that, okay, instead of mainland doing international business, we'll have a free zone company which will do international business, and you shift all the operations, you'll have to ensure that you get this assurance from the free zone authority that yes, corporate tax exemption is there for the companies that you are registering.
Right. I have one more question. Will a tax loss relief be available if losses are incurred before the effective date of corporate tax?
No. Tax relief will not be available if the loss is incurred before the year starts, that financial year, or if you not become a taxpayer before that date, if the losses are incurred, then no, tax relief won't be available.
Correct.
It's a simple, there are no transition provisions as far as this law is concerned. So it very clearly says effectively from the date you are liable. So 1st June 2023 onwards, financial year, whatever starts. So profits or losses that you incur or earn after that period.
Correct. In case of property, if the value of property increases but the property is not yet sold, the gains will be recorded in the books of account for accounting purpose, though they will not be realized. How will this be treated under tax?
Unrealized gains. Sorry, Kinshal, go ahead.
Oh yeah, so I was just saying this is unrealized gains or profit. This is a query on that, right? So basically the value of the property has gone up, but actually it is not realized because it's not yet sold. So for the purpose of accounting, I think IFRS will have to, record this, the increase in the value. But for the tax purposes, they have not given any such rules for the unrealized. Yeah, but it all depends on whether the nature of this is a revenue expense, it's a revenue item or a capital item. So based on that, unrealized gains or losses will have to be
correct.
Yeah, just to add to that, what Kinjal said, primarily unrealized gains or losses on capital items will not be taxable. But if it is revenue item, for example, you have inventory and there is, let's say, unrealized gain or loss because the inventory value has fluctuated when you do the valuation. That's a revenue part, and that might get taxed even if it is unrealized. So revenue items unrealized, yes, there is a probability taxability would be there.
The next question is, what are the documents that the company requires to maintain for corporate tax purpose?
Full sets of books of accounts and much more than that, because what will happen is it's one, complete accounting records will have to be in perfect order. All the supporting documents will be required, because if you are claiming certain expenses as deductible expense, obviously you need proper supporting documents. Apart from that, you will also require agreements, because if you have transactions with related parties, for example, you'll have to prove it's on arm's length basis. So transfer pricing assessment will need to be carried out. And also agreements, maybe if you are dealing with, let's say though you are dealing with one major customer and supplier, you claim that it's not a related party. There is a possibility the authorities could raise a question that you are dealing with only one or two or very few customers and suppliers, and you are generating profits. Are they not related? Prove it. So you may need to prove. So there are many documents and information that will be required. And again, you have to bear in mind, like VAT, here also you will have a period up to which the authority will have the ability to go back. Like in India also, you have that it can go back 4 years or 8 years. Like in VAT, it can go back, assessment can go up to 5 years. So you'll have to maintain those records for probably in all, I would say 6 to 7 year period, all these documents.
Correct.
Also,
And
just to add one point in this, it's not only for the companies who are mainland companies, even the companies which are exempted will have to maintain these records to establish the exempted status.
Yes, so exempted, even free zones, 0%, but they still need to do the filing.
Correct.
Even if it is 0%, you'll have to claim that and you'll have to still do the filing. So obviously, and you need audited financials. That's very clear if you are claiming such 0% benefit.
So next question is that only will the UAE companies need to mandatorily get their financials audited? So as far as free zone entities are there who are claiming exemption, audit is compulsory. But for mainland companies right now, it is not clear whether audit will be required or not.
It's not, probably it's not given in the law that it is required, but as I would say again, when the assessment happens based on the experience from VAT, audited financial statements would always be, it's better to have them as a supporting document.
Correct. And we have a question where, can you please describe in which free zone in Dubai will be considered as zero rated? So that again is $1 million question. So
see, most of the free zones say they are giving corporate tax exemption. But again, as I said, the FTA will come out with its list of the free zones which will be eligible for giving this benefit.
correct. And what is the situation for offshore companies based in Jafza and that of representative offices?
See, all companies which are licensed, which are having, which are incorporated and registered will be liable. So even offshore companies, if they are doing business locally, would be taxable.
Correct. Then what about what will be the position of UAE citizens having businesses outside UAE and income from the same? So UAE citizens or residents,
not,
it doesn't impact.
individuals are not covered. So see, if again, individuals carrying out business locally, obviously, they will be taxable. But individuals, let's say, have invested in some assets overseas, they have some dividend income, they have some, foreign income by way of interest, dividends, or such passive income, it will not be taxed.
Correct. So next question is on if the year ending is 31st March, what will be the first year when the corporate tax will be applicable? So it will be from 1st April 24 to 31st March 25.
Correct.
Yes.
The first tax return would be by 31st December 25.
Yeah. No, so the taxable year will be from 1st April 24 to 31st March 25. That will be the taxable period, correct?
31st December 25 will be the
March ending. No? So 1st
March
April.
ending it is.
1st April 24 to 31st March 25 will be the first financial year on which corporate tax would be, they will be liable to pay.
And we have a question, mainland entity with no abroad or free zone income earning, do we still need to maintain separate books of accounts for the corporate tax, or financial account itself will do?
Mainland entity with no abroad, or see, anyway, books of accounts will have to be maintained. What I am assuming is maybe they have mainland entity and free zone, but they
Yes.
don't have any international business. So they are not claiming 0% corporate tax benefit. If they're not claiming 0% corporate tax benefit, they will have to pay 9%. Now, whether they will be registered as individual mainland company or mainland plus free zone as a group depends on that, whether they need combined books or they need separate books of accounts. See, books of accounts, again, let me emphasize here, it's not just because of corporate tax. You have a lot of other compliances now in UAE. You have value added tax, you have economic substance requirements, you have anti-money laundering requirements. Now, because of all this, it's all necessary that every company needs to maintain, and it is there in the law also that every company is required to maintain books of accounts. Now, only thing is whether they need to get it audited or not is dependent on those regulations, because offshores do not need, but most of the free zones require audit. Even in mainland, for LLC, there is a law, LLC law, that the accounts needs to be audited. Though you do not have a filing requirement, that's a different thing. But the law says that accounts have to be audited. So books have to be maintained by each and every company. And in my view, it is always better now, considering this document, tax grouping is going to be challenging because the criteria are quite stiff. Considering that every company, every license that you have, of course, license would mean the main company and the branches, you will have to maintain one set of books of accounts. Then you have second company, you will have to maintain second separate books in all probability, because grouping is going to be challenging.
Then one question is that we have two companies, one in mainland, one in free zone. Can we create a group registration or can we create a tax group? So that is possible.
Possible, but then you cannot ask for free zone company, you cannot have the 0% benefit then.
Correct. Then if a mainland company has a branch office in one of the free zones, and with the introduction of CT, do we need to maintain a standalone audited financial statements for the free zone branch as well?
Yes, because if you're again, free zone entity claiming benefit of 0%, we'll have to maintain separate books.
Can a Jazza company earning income from rentals on the residential units come under the preview of CT?
Yeah, I mean, all companies' income will be liable to tax. See, as far as corporate income is concerned, it's not apart from dividend and capital gains and all that, which is being granted as exemption. All other income by any company will be liable to tax. So that, I believe, would include the rental income also.
Correct. Then there is a free zone company selling to local company, receiving payments from mainland, but the goods are shipped to foreign country. So transaction is between two local companies, but however, I think it is third port shipment. Yeah,
but then you are generating income from a local company. You are selling to a local company, so it's a local transaction. This again, see, now structuring can happen legally, provided both companies were in free zone. So one free zone company is selling to another free zone company, and the goods are being delivered third port. In that case, 0% possibility was there.
Correct. Then one question is that the tax is based on a net profit or turnover. So it is on adjusted net profit, not on turnover. So net profit, you'll have to add back all the non-allowable expenses, and then the adjusted net profit, you have to charge the corporate tax rate. And we have a free zone company sells service totally internationally, but takes some services from UAE based on base companies. Are we liable to pay tax?
Pardon?
So it's a free zone company providing only services to foreign companies. So then they can avail exemption.
Yeah, they can avail.
Provided
so again,
they fulfill.
So foreign companies now will have to see that foreign companies should not have a permanent establishment.
Correct.
Like in VAT also, you have export of services where person receiving the service should not be in UAE and all that. So, there will be, I am sure, for intangibles, specifically services from overseas, there will be detailed rules and guidelines, like we have it in VAT also, because intangible is very difficult to monitor where it has been rendered and where the service is delivered. So I think there are a lot of such things which will only become clear when the corporate tax law is announced.
Correct. Then managing partner remuneration, is it allowable expense under corporate tax?
Yeah, it would be allowed, but again, you'll have to justify that. Again, see, it's an arm's length. Suppose a third-party professional managing director was appointed, what would be the salary scale? So you'll have to justify. So you cannot have any figure and any high figure as being just charged and allowed. I'm sure this will be questioned. So justification will need to be there that for a person of that caliber, what salary should have been there.
Then will freelancer income will be taxed? So someone has a freelancer visa in the UAE.
Yeah, they have a license, freelancer license. So freelancer license, and it clearly says no, any person carrying out commercial activity will be liable to tax.
Correct.
So there are, sometimes people don't take any license, for example, neither freelancer nor anything, and they still carry out commercial activity. It is illegal by law. You cannot carry out any commercial activity in UAE without having proper license, either freelancer or a proper, commercial or trade or service license. Correct. So if person is carrying out any such activity without license, it is illegal, but definitely it will be liable to corporate tax.
One last question: how tax will be paid in case of profits to be remitted to foreign partners? In case of all kinds of partnerships and ownerships as well, as it is zero withholding tax.
They will have to register. That individual foreign partner also will be registered as a taxpayer, and they will have to file return on their share of profit.
Correct.
They'll have to report and pay tax on their share of profit. However, it remains to be seen now, the threshold level of 375 would be applicable to that individual.
Correct. And one question is that office rent of mainland company paid to office owner who is a shareholder of the company. Will this be allowed as a deductible expense?
It should be allowed as long as you can justify that, yes, office is used for business purpose. And again, rent on arm's length equivalent premises, if let's say he would have taken from any third party, how much would have been the rent?
And what about real estate owned by individuals? Rental income on real estate owned by individuals?
Not taxable.
Not taxable.
Not taxable.
So I guess this is it. This is all the time we have. So I hope a lot of questions were clarified and answered, and the participants have gained a lot of valuable insight into the proposed corporate tax law. Now I hand over to Jyotika for proposing the vote of thanks. Jyotika.
Thank you, sir. So that brings us to the end of the session. Thank you so much for your time and participation. It was a pleasure having you all with us today. And if you still have any queries, do not hesitate to reach out to us. We shall be more than happy to assist. Thank you.
Sorry, I was just looking at I think there are a couple of questions in the Q&A also. I think year end is 31st August and CT will be calculated for entire year or only from June to August. No, since your financial year is 31st August, for you it will be applicable for financial year starting from 1st September 2023 onwards. So 1st September for you, first year will be September 23 to August 24. Okay, sorry, Jyotika.
Okay, thank you, sir. So we hope most of your queries are resolved, but if you're still left with any questions, you can always reach out to us and we shall be more than happy to assist. Thank you so much, everyone, for your time and participation. Thank you.
Thank you everyone for joining, and we'll circulate the presentation. And of course, as Jyotika mentioned, if you have any questions or need any further clarification, you can always email it to us and we will be glad to respond to you. Thank you everyone.